Hey everyone, and welcome to The Explainer. Today, we are diving into some absolutely mind-blowing territory at the bleeding edge of decentralized finance. We're going to explore the hidden fragility and, honestly, the strict physical limits of a multi-billion-dollar mathematical marvel. We often think of blockchain architecture as this pristine, perfectly engineered landscape, right? But when visionary developers push the math to its absolute extreme just to solve massive liquidity problems, things get incredibly fascinating and, frankly, a little bit dangerous. So we're pulling back the curtain on high-dimensional liquidity pools to see exactly what happens when perfect theory collides with messy, chaotic human reality.
Here is our roadmap for today's forensic breakdown. We're going to start with the multidimensional AMM vision, then look at the hardware determinism trap. After that, we hit floating point drift under stress, move into the multi-coin fragility trap, explore catastrophic divergence loss, and finally wrap up with hedging with polar ticks.
All right, let's jump into Section 1, the multi-dimensional AMM vision, trading 10,000 stablecoins in a single pool.
Okay, so let's start with the utopian vision of orb swap and n-dimensional automated market makers, or AMMs. Imagine a future with millions of digital assets. Historically, if you wanted to support just 20 stablecoins, you mathematically had to create exactly 190 completely disconnected trading pools. That just heavily fractures liquidity and leaves users with terrible exchange rates. So, top-tier architects started asking this wildly ambitious question. How do we build a single unified liquidity pool for 10,000 stablecoins at once without completely fragmenting the capital? Well, to solve this, developers pivoted to high-dimensional geometry. Instead of traditional flat 2D grids that rely on really messy division and square roots, they map liquidity onto circular manifolds, specifically a shape called a superellipse. By using polar coordinates, they can just rotate trades around a central focal point using simple trigonometry. In a stablecoin pool where everything is perfectly priced at $1, the neutral polar tick sits flawlessly at a 45-degree angle. This omnidirectionally concentrates capital density right where it belongs. It's basically a massive, unified donut of liquidity that seamlessly handles dozens of tokens.
Moving on to Section 2, the hardware determinism trap, the grand computational illusion.
But here is where we have to pivot to a shocking physical reality. This is where that pristine mathematical blueprint just crashes headfirst into concrete. We intuitively feel like computers always calculate perfect, exact answers, right? Actually, scratch that. Beneath the surface, when you ask a processor to do complex, continuous math like those smooth superellipses, it heavily relies on hardware-level approximations. It's essentially just guessing. Researchers call this the grand computational illusion. On one hand, we have the floating point unit, which we can call the FPU gambler. It's incredibly fast, for sure, but it's probabilistic and mathematically lossy. It's basically throwing darts to find an answer. On the other hand, we have the arithmetic logic unit, the ALU surveyor. Now, the surveyor is strict, discrete, and relies on 100% deterministic integer logic. So the massive hardware conflict operating right beneath our financial protocols is this. Blockchains absolutely demand the strict determinism of the surveyor, but those smooth geometric curves, they demand the gambler.
And when engineers try to force those beautiful continuous curves into the strict Ethereum virtual machine, or EVM, they hit a massive brick wall. The EVM has absolutely no native floating point math at all. It uses a rigid 256-bit word size. So to even survive on-chain, those flowing polar coordinates must be forcefully translated into strict fixed-point integers. This creates massive mathematical overhead and really severe rounding errors. It triggers something called the wood chipper effect, which literally destroys the exact provenance of the data. You compress, you guess, and you can never perfectly reverse engineer that math back to its original pristine state.
Which brings us to Section 3, floating point drift under stress, or when the math violently breaks.
Now you might be wondering, what's the big deal about a microscopic rounding error of a fraction of a cent? Well, on a calm sideways trading day, it seems entirely harmless. But that is exactly the trap. These tiny hardware flaws expose a catastrophic vulnerability when extreme market stress hits. We have to look at what happens when that FPU gambler is pushed to the absolute brink. 85 cents. I really want you to feel the visceral weight of that number. During the terrifying Silicon Valley Bank collapse in March 2023, USDC, which was widely considered one of the safest assets in all of crypto, violently depegged and plunged to 85 cents on the dollar. Instantly, millions of users panicked at the exact same time, fleeing USDC and dumping it for anything perceived as safe.
So what happens when you push millions of extreme, panicked trades through this high-dimensional floating point math?
The foundation absolutely shatters. Extreme panic violently stretches the trigonometric angles of the pool. And to cope with the lack of decimals in the EVM, developers often use these band-aid fixes, like multiplying those sloppy angles by a massive scaling factor of 10,000. But multiplying a bad guess by 10,000 doesn't fix the math, it actively ruins it. It blows up the hardware approximations, causing this severe, non-deterministic financial drift that can literally break the smart contract's cryptographic consensus. There's just no way around it.
Let's dive into Section 4, the multi-coin fragility trap, the Icarus flight of n greater than 2 pools.
This brings us to the most systemic danger of the whole shebang. As developers push to include 3, 4, or even dozens of stablecoins into one high-dimensional pool, what we call n greater than 2 pools, they are actively building a massive, intricate house of cards. They're totally assuming these assets will always behave normally. But real market data proves that stablecoins are not flat lines. They exhibit multimodal liquidity fingerprints and fat-tailed behavior. We see massive asymmetric negative skews because, while humans naturally panic, or they hit redemption fee barriers, which completely warps the distribution. The pure math assumes a perfectly symmetrical, normal distribution around a $1 peg. But human fear creates sharp, violent downward spikes that these perfect geometric shapes simply do not expect.
And this leads directly to structural failure, which we can actually measure using the Herfindahl-Hirschman index, or HHI. Basically, this index tracks the angular clustering of liquidity. During call markets, liquidity providers cluster all their capital really tightly around that perfect 45-degree angle to maximize their efficiency. But if a stablecoin depegs and prices drift past that incredibly narrow concentration band, the HHI abruptly collapses. All of that tightly clustered liquidity becomes entirely useless, exposing a complete lock of depth in the outer price ranges exactly when the market needs it the most.
All right, Section 5, Catastrophic Divergence Loss, the Death Spiral Sequence.
So what actually happens to the people providing capital when this whole thing breaks? It builds into a horrific mechanical trap. In an n-dimensional pool, the entire structure acts as this super-efficient drainage mechanism during a true black swan bank run. Let's walk step by step through this inescapable death spiral. Step 1. A depeg triggers massive human panic. Step 2. The automated market maker doesn't feel fear, right? It has no human context, so it just blindly executes the math on the polar curve. Step 3. Arbitrageurs aggressively dump the crashing token into the pool, which drains all the valuable, healthy assets. And finally, Step 4. The AMM physically forces the liquidity provider to be the buyer of last resort, accumulating and hoarding the plummeting asset all the way down to zero. You suffer catastrophic divergence loss simply because a single point of failure dragged the entire multi-coin pool down with it.
Which takes us to our final part, Section 6, Hedging with Polar Ticks, the mathematical life raft.
Thankfully, there is some good news. The researchers studying this fragility have actually mapped out a survival strategy. If you're going to risk providing capital in these fragile multi-coin pools, there's a brilliant way to use the protocol's own mathematical building blocks against itself to create a life raft. You can literally build depeg insurance entirely on-chain. You create a synthetic binary prediction market directly inside the AMM. Here's how. You find an unused polar tick way out of the normal trading range, say 1 degree out from the peg, and you build a long position. Then you borrow, unwrap, and short a second position immediately below it. By combining them into a precise vertical spread, if the stablecoin permanently crashes right through that tick, your synthetic option triggers a guaranteed payout. This covers the massive divergence loss that just destroyed your main position. It's a real game changer.
It is an incredibly ingenious use of geometry to survive a disaster. But it does leave us with this final, stark question to ponder as we continue to build out these massive algorithmic ecosystems. We can invent high-dimensional superellipses, and we can rotate them through polar coordinates with perfect algorithmic grace. But at the end of the day, can pristine mathematical truth ever truly tame the messy, fat-tailed chaos of human panic? Keep questioning the systems you rely on, and I'll catch you in the next explainer.